April 2026 is about to deliver the most dangerous macro collision Wall Street has seen in years. The Federal Reserve meeting is happening in the exact same week as big tech earnings. This is not a coincidence, and institutional money knows it. Right now, US stocks are soaring to levels that make even seasoned traders nervous. The S&P 500 has been on a relentless climb, but smart money is quietly repositioning. While retail investors are celebrating new highs, Wall Street is buying protection. Let me show you why this week separates institutional strategy from retail hope. The Fed is walking into this April meeting with a nightmare scenario. Tech valuations are at historic extremes, geopolitical tensions are spiking oil prices, and now they have to make a rate decision. Every single Fed meeting this year has been relatively predictable, but this one is different. Big tech earnings are landing in the same 48-hour window as the Fed announcement. That means two massive volatility events are compressing into one explosive moment. When you overlay earnings uncertainty with monetary policy uncertainty, you create what institutional traders call a liquidity trap. Retail investors see this as excitement, but smart money sees it as risk. Here is the data cross-verification that nobody on Main Street is talking about. First, the options market is screaming caution. Implied volatility on the Nasdaq 100 has spiked to levels we have not seen since the banking crisis of early 2020. That tells you institutional traders are paying up for downside protection right now. Second, look at the economic data calendar for this exact week. We are getting GDP revisions, PCE inflation data, and jobless claims all before the Fed decides. If any of those numbers come in hot, the Fed is boxed in, and tech multiples get compressed instantly. The Fed cannot ignore inflation, and they cannot ignore a slowing labor market at the same time. This is the definition of a policy trap, and it is happening during peak earnings season. Now let me give you the tactical ticker strategy that flows directly from this setup. If you believe the Fed stays hawkish and tech earnings disappoint, you want exposure to defensive rotation. Ticker 1, XLU, the Utilities Select Sector ETF. Utilities outperform when growth stocks get repriced and investors flee to dividend safety. Ticker 2, SQQQ, the ProShares Ultra Pro Short QQQ. This is a leveraged inverse Nasdaq ETF that explodes when tech sells off hard. Institutional traders use this for short-term hedges during binary events like Fed Week. Ticker 3, GLD, the SPDR Gold Shares ETF. Gold has been range-bound recently, but central bank rate decisions historically trigger breakouts in precious metals. If the Fed signals any dovish pivot, or if geopolitical risk escalates further, gold rips. These three tickers are not random picks. They are derived directly from the macro cross-currents we are seeing right now. Now, let me take you back to a historical case study that is eerily similar to today. April 2000, the Nasdaq was at all-time highs after a euphoric rally. The Fed was in the middle of a rate hiking cycle, and big tech earnings were about to be reported. Retail investors were convinced the rally would continue forever. Then the Fed held rates higher than expected, and tech earnings came in mixed. The Nasdaq collapsed 35% over the next 8 weeks. That was not a crash caused by one event, it was a compression of multiple macro risks hitting at the same time. Sound familiar? Because that is exactly what is setting up in April 2026. The difference today is that institutional money has learned from 2000. They are not waiting for the crash, they are hedging before it happens. You can see it in the options flow, you can see it in the VIX term structure, and you can see it in the bond market. Smart money is not panicking, they are positioning. The final piece of this puzzle is geopolitical risk, which most retail investors are ignoring. Oil prices are spiking because of Iran-US tensions, and that is happening right as the Fed meets. Rising oil means rising inflation expectations, which means the Fed cannot pivot dovish, even if they want to. That boxes in policy and creates a scenario where both stocks and bonds can sell off together. When that happens, there is nowhere to hide except cash, gold, or inverse positions. This is why Wall Street is retreating to the fence right now. As one headline perfectly described it, they are not committing capital, they are waiting for clarity. But retail investors are still buying the dip, which is exactly what creates the liquidity for smart money to exit. Here is the bottom line. This week is not about predicting what the Fed will do or what tech earnings will be. It is about understanding that when two massive volatility events collide, the risk-reward skews heavily toward caution. Institutional money is hedging, rotating, and reducing exposure to high beta tech names. If you are still holding concentrated positions in momentum stocks without any protection, you are on the wrong side of smart money flow. The market does not care about your conviction. It cares about liquidity and positioning. And right now, positioning favors those who are prepared for volatility, not those chasing it. This is not fear-mongering. This is institutional-grade risk management. The same strategies that protect billion-dollar portfolios are available to you if you know where to look. Watch the options flow this week. Watch the Fed language closely, and watch how tech stocks react in the after-hour sessions. Those 3 data points will tell you everything you need to know about where smart money is heading next. April 2026 is the week that will define the next quarter of market direction. Make sure you are positioned like an institution, not like the crowd.